Question 1. A trader places a buy stop $50, limit $50.10 order. If the current market price is $49.50, what action will occur if the stock subsequently trades at $50.05? A. The order will be executed immediately at $50.05. B. The order will become a live limit order to buy at $50.10 or better. C. The order will be cancelled as the limit price was breached. D. The order will remain a stop order until the price reaches $50.10. Answer: B. The order will become a live limit order to buy at $50.10 or better. Explanation: A buy stop limit order has two components, a stop price and a limit price. When the stock trades at or above the stop price, $50 in this case, the order is triggered and immediately becomes a limit order. Since the trigger occurred at $50.05, the order becomes a live limit order to buy at $50.10 or better. The order will then only execute at $50.10 or a lower price, ensuring the buyer does not pay more than their specified limit. Question 2. Which of the following activities is most directly prohibited by the FINRA Anti-Reciprocal Rule, Rule 2310, regarding investment companies? An investment company directing portfolio trades to a broker-dealer in exchange for that broker-dealer selling shares of the investment company. B. A broker-dealer executing trades for an investment company at prices that are not the best available in the market. C. An investment company providing research services to a broker-dealer in exchange for increased trading volume. D. A broker-dealer offering free educational seminars to clients of an investment company. Answer: A. An investment company directing portfolio trades to a broker-dealer in exchange for that broker-dealer selling shares of the investment company. Explanation: The Anti-Reciprocal Rule, FINRA Rule 2310, formerly NASD Rule 2830, specifically prohibits a broker-dealer from selling shares of an investment company on the condition that the investment company directs its portfolio brokerage commissions to that broker-dealer. This practice, known as reciprocal business, is considered a conflict of interest as it may incentivize broker-dealers to recommend investment company shares based on commission benefits rather than the client's best interest. The rule aims to ensure that investment decisions are made solely on the merits and in the best interest of the investment company's shareholders. Question 3. Under Regulation NMS, what is the primary purpose of the Order Protection Rule, Rule 611? A. To ensure that all orders receive execution within 30 seconds of being placed. B. To prevent broker-dealers from internalizing customer order flow. C. To mandate that trading centers establish procedures to prevent trade-throughs of protected quotes. D. To limit the spread between the bid and ask prices for NMS stocks. Answer: C. To mandate that trading centers establish procedures to prevent trade-throughs of protected quotes. Explanation: The Order Protection Rule, Rule 611 of Regulation NMS, requires trading centers to establish, maintain and enforce policies and procedures reasonably designed to prevent trade-throughs of protected quotes. A protected quote is a displayed, immediately accessible best bid or offer from an automated trading center. This rule ensures that investors receive the best available prices nationwide, preventing an order from being executed at an inferior price on one market when a better price is available and displayed on another market. Question 4. Which of the following is not a characteristic of a dark pool? A. It typically offers price improvement for large block orders. B. Its order book is generally not displayed to the public. C. It provides pre-trade transparency for pending orders. D. It is an alternative trading system, ATS. Answer: C. It provides pre-trade transparency for pending orders. Explanation: Dark pools are alternative trading systems, ATSs, that allow institutional investors to trade large blocks of securities anonymously without their orders being displayed publicly. Their primary characteristic is the lack of pre-trade transparency, meaning the order book and prices are not visible to the general market before execution. While they can offer price improvement for large orders, their non-displayed nature is what defines them, differentiating them from traditional exchanges where quotes are public. Question 5. A broker-dealer engaging in spoofing would most likely be doing which of the following? A. Placing non-bona fide orders with the intent to cancel them before execution, to create a false impression of market interest. B. Executing trades based on material, non-public information. C. Entering a series of trades that create artificial price movements but result in no change in beneficial ownership. D. Delaying the execution of customer orders to trade ahead for the firm's own account. Answer: A. Placing non-bona fide orders with the intent to cancel them before execution, to create a false impression of market interest. Explanation: spoofing is a manipulative trading practice where a trader places large, non-bona fide orders with the intent to cancel them before they are executed. The purpose of these orders is to create a false impression of supply or demand in the market, misleading other traders and influencing prices to benefit other positions the spoofing trader holds or intends to take. This deceptive practice is illegal and violates market integrity by creating an artificial market appearance. Question 6. Under Regulation SHO, which of the following is a primary requirement that aims to prevent naked short selling? A. Broker-dealers must increase margin requirements for all short sale positions. B. Broker-dealers must establish procedures to prevent trade-throughs of protected quotes for short sales. C. Before executing a short sale, a broker-dealer must have reasonable grounds to believe the security can be borrowed and delivered, the locate requirement. D. All short sale orders must be executed on an exchange, not in a dark pool. Answer: C. Before executing a short sale, a broker-dealer must have reasonable grounds to believe the security can be borrowed and delivered, the locate requirement. Explanation: Regulation SHO's locate requirement, Rule 203b, 1, mandates that a broker-dealer must have reasonable grounds to believe that the security can be borrowed and delivered on settlement before executing any short sale order in an equity security. This is a fundamental requirement to prevent naked short selling, selling shares one does not own or has not borrowed, and ensures orderly settlement of transactions. Other provisions of Reg SHO, like the closeout rules, address what happens if a fail to deliver still occurs. Question 7. A market on close, MOC, order for an NYSE-listed stock is typically submitted with what timing constraint? Any time during market hours to be executed at the last price of the day. B. Before a specific cutoff time, typically 3:50 p.m. Eastern Time, to execute at the closing price. C. Only during the pre-market session to execute at the opening price. D. At market open to be executed at the market close. Answer: B. Before a specific cutoff time, typically 3:50 p.m. Eastern Time, to execute at the closing price. Explanation: a market on close, MOC, order is designed to execute at the closing price of a security on a specific exchange, such as the NYSE. These orders are subject to specific submission and cancellation deadlines. For NYSE, MOC orders typically must be submitted by 3:50 p.m. Eastern Time and cannot be cancelled or modified after 3:58 p.m. Eastern Time. This allows for orderly processing and aggregation of orders to determine the official closing price. Question 8. A proprietary trader for a broker-dealer places a series of small non-bona fide buy orders at successively higher prices in a thinly traded stock. These orders are then quickly cancelled just before a large sell order for the same stock is executed, taking advantage of the artificially inflated price. This is a potential example of which manipulative practice? Front running. B. Wash sale. C. Layering. D. Churning. Answer: C. Layering. Explanation: layering or spoofing involves placing multiple non-bona fide orders, often on one side of the market, at various price points with the intent to cancel them. This creates a false impression of market interest or depth. The trader then places a legitimate order on the opposite side of the market, or exploits the induced price movement, and hopes to execute it against market participants who react to the false liquidity. Once the legitimate order is filled, the non-bona fide orders are quickly cancelled. This is a manipulative practice designed to trick other traders into moving prices. Question 9. Which entity is primarily responsible for establishing the uniform trade date and settlement date for most securities transactions in the U.S. markets? A. The Securities and Exchange Commission, SEC. B. The Financial Industry Regulatory Authority, FINRA. C. The National Securities Clearing Corporation, NSCC. D. The Federal Reserve Board. Answer: C. The National Securities Clearing Corporation, NSCC. Explanation: the National Securities Clearing Corporation, NSCC, a subsidiary of the Depository Trust and Clearing Corporation, DTCC, is the central clearing agency for virtually all broker-to-broker equity, corporate bond, and municipal bond trades in the U.S. markets. The NSCC plays a critical role in standardizing and streamlining the post-trade processing, including establishing uniform trade and settlement dates, e.g., T+2 for most equities. This reduces risk and improves efficiency by acting as the central counterparty for eligible transactions. Question 10. A registered representative learns that their firm's research department is about to release a highly positive report on XYZ Corporation. Before the report is made public, the registered representative purchases XYZ stock for their personal account. This is an example of churning. B. Front-running. E. Insider trading. D. Market manipulation. Answer: B. Front-running. Explanation: front-running occurs when a broker-dealer or registered representative executes trades for their own account or a proprietary account based on advanced knowledge of a pending customer order or, in this case, a firm's research report that is expected to move the market. By trading ahead of the information's public release, the individual seeks to profit from the anticipated price movement before the general public has access to the information. This practice violates fiduciary duties and fair dealing principles. Question 11. Which of the following best describes the key pricing control difference between a stop order and a stop limit order to sell? A stop order will always execute at a predetermined price, while a stop limit order may not. B. A stop limit order allows the seller to specify a minimum acceptable price, unlike a stop order. C. A stop order is primarily for long positions, while a stop limit is for short positions. D. A stop order becomes a market order, while a stop limit order becomes a day order. Answer: B. A stop limit order allows the seller to specify a minimum acceptable price, unlike a stop order. Explanation: a sell stop order becomes a market order once the stop price is triggered, meaning it will execute at the best available price regardless of how low that price might be, offering no control over the execution price. Conversely, a sell stop limit order becomes a limit order once triggered, specifically allowing the seller to specify a minimum price, the limit price, below which they will not sell. This provides price protection, which is the key pricing control difference compared to a simple stop order. Question 12. Under FINRA rules, what is the closeout requirement for a fail-to-deliver position resulting from a short sale in an equity security? A. The firm must close out the position within 24 hours of the fail-to-deliver occurring. B. The firm must close out the position no later than the beginning of regular trading hours on the third business day after the settlement date, T+5. C. The firm must close out the position only if the security is on the threshold list. D. The firm must close out the position within 5 business days if the fail is over $1,000. Answer: B. The firm must close out the position no later than the beginning of regular trading hours on the third business day after the settlement date, T+5. Explanation: under Reg SHO Rule 204, if a participant of a registered clearing agency has a fail-to-deliver position in an equity security, the participant must close out the fail-to-deliver by purchasing or borrowing securities. For short sales, if a fail-to-deliver exists at a clearing agency, the participant must close out the fail-to-deliver no later than the beginning of regular trading hours on the third business day after the settlement date, i.e., T+5 assuming T+2 settlement. This rule aims to prevent abusive naked short selling and ensure timely settlement. Question 13. What is the primary role of a qualified block positioner, in the context of NYSE Rule 72? A. To execute trades for retail customers on the exchange floor. B. To facilitate the execution of large block trades by acting as a principal. C. To provide continuous two-sided quotes for a designated security. D. To manage the order book for the designated market maker. Answer: B. To facilitate the execution of large block trades by acting as a principal. Explanation: A qualified block positioner is a specialized broker-dealer that facilitates the execution of large block trades for institutional clients. Under NYSE Rule 72 and similar rules, Block positioners can take large positions as principal to accommodate institutional orders that are too large to be absorbed by the market's normal liquidity. They essentially step in to buy a large block from a seller or sell a large block to a buyer, then work to liquidate or cover their position over time, thereby providing crucial liquidity for large transactions. Question 14. A broker-dealer allows a customer to repeatedly purchase and sell a security on the same day without taking possession, purely for speculative purposes to profit from intraday price movements. This activity is best described as hedging. B. Pattern day trading. C. Arbitrage. D. Position trading. Answer B. Pattern day trading. Explanation. Pattern day trading involves executing 4 or more day trades, the opening and closing of positions in the same security on the same day, within a 5-business day period in a margin account. FINRA rules require pattern day traders to maintain a minimum equity of $25,000 in their margin account. This activity is characterized by its high frequency and speculative nature, seeking to profit from short-term market fluctuations. Question 15. Which of the following is most likely to be considered a restricted person, under FINRA Rule 5130, regarding new issues? An institutional investor with assets exceeding $100 million. B. A portfolio manager of a mutual fund with no direct beneficial ownership in the new issue. C. An immediate family member of a person associated with a broker-dealer that is underwriting the new issue. D. A foreign government entity purchasing for its sovereign wealth fund. Answer. C. An immediate family member of a person associated with a broker-dealer that is underwriting the new issue. Explanation. FINRA Rule 5130, known as the New Issue Rule, prohibits broker-dealers from selling new issues (IPOs) to restricted persons. Restricted persons include FINRA member firms, their employees, immediate family members of employees, if there's material support, shared household or joint account, and other industry insiders. The purpose is to prevent industry professionals from profiting from the hot issue market at the expense of public investors, ensuring that new issues are distributed fairly. Question 16. What is the primary function of a Securities Information Processor, SIP, in the U.S. equities market? A. To execute customer orders at the best available price. B. To consolidate and disseminate the best bids and offers from all exchanges and quotation services. C. To regulate trading activity and enforce market rules. D. To provide a venue for trading unlisted securities. Answer. B. To consolidate and disseminate the best bids and offers from all exchanges and quotation services. Explanation. Securities Information Processors, SIPs, are mandated by the SEC under Regulation NMS to collect, consolidate and disseminate all protected quotations and last sale reports for NMS stocks from all exchanges and other trading venues. The SIPs, such as the Consolidated Tape Association (CTA) and Unlisted Trading Privileges (UTP) plan, create a national best bid and offer (NBBO) for each stock, which is essential for ensuring price transparency and facilitating best execution across the fragmented U.S. market. Question 17. A limit order to buy 100 shares of ABC at $45, marked FOK, is entered. If there are currently only 50 shares available at $45, what will happen to the order? A. The order will be partially filled for 50 shares and the remainder cancelled. B. The entire order for 100 shares will be cancelled. C. The order will remain open until 100 shares become available at $45. D. The order will be filled for 50 shares at $45 and 50 shares at $45.01. Answer. B. The entire order for 100 shares will be cancelled. Explanation. A fill or kill (FOK) order instruction requires the entire order to be filled immediately and completely or it is cancelled. In this scenario, since only 50 shares are available at the limit price of $45, and the order is for 100 shares, the condition of fill, entire quantity, cannot be met. Therefore, the entire order for 100 shares will be immediately cancelled without any partial execution. This ensures the trader only gets their full desired quantity at the specified price. Question 18. Which of the following would require a person to register as a large trader, under SEC Rule 13H1? A. A firm executing 20 million shares in a calendar month. B. An individual trading 1 million shares in a calendar day. C. A hedge fund trading 2 million shares in a calendar month and 20 million shares in a calendar year. D. A foreign institution trading 500,000 shares in a calendar day. Answer: A. A firm executing 20 million shares in a calendar month. Explanation: SEC Rule 13H(1) requires large traders to identify themselves to the SEC and obtain a large trader ID, LTID. A large trader is defined as a person who, directly or indirectly, exercises investment discretion over accounts that conduct transactions in NMS securities equal to or exceeding 2 million shares or $20 million during any calendar day, or 20 million shares or $200 million during any calendar month. A firm executing 20 million shares in a calendar month meets the monthly shares threshold for registration. Question 19. An equity option contract with a European-style exercise feature can be exercised at what point? Any time up to and including the expiration date. B. Only on the expiration date. C. Only on the third Friday of the expiration month. D. Only if the option is in the money by a certain amount. Answer: B. Only on the expiration date. Explanation: European-style options can only be exercised on the expiration date, unlike American-style options which can be exercised at any time up to and including the expiration date. This distinction is crucial for traders as it affects liquidity, pricing, and strategies. While American-style options offer more flexibility, European-style options are simpler and generally carry lower premiums due to the restricted exercise window. It's important to remember that most equity options in the US are American-style, but many index options and some currency options are European-style. Question 20. What is the primary concern when a broker-dealer is involved in parking securities? A. Failure to properly disclose transaction costs to the client. B. Attempting to circumvent net capital requirements or hide ownership of securities. C. Executing trades at prices inferior to the national best bid or offer. D. Trading for the firm's proprietary account ahead of a customer order. Answer: B. Attempting to circumvent net capital requirements or hide ownership of securities. Explanation: Parking refers to an illegal arrangement where a broker-dealer temporarily transfers securities to another firm or an associated person with an understanding that the securities will be transferred back later. The primary concern is that this is done to conceal actual ownership, circumvent regulatory requirements, like net capital rules, avoid margin calls or manipulate financial statements. It is a deceptive practice designed to hide true positions or financial conditions from regulators and the public. Question 21. Which of the following is subject to the provisions of SEC Rule 10b-18, Safe Harbor for issuer repurchases? A. A tender offer by an issuer to repurchase its own shares. B. An open market purchase of its own common stock by an issuer. C. A registered secondary offering of shares by an issuer. D. A block trade facilitated by an underwriter for an issuer. Answer: B. An open market purchase of its own common stock by an issuer. Explanation: SEC Rule 10b-18 provides a safe harbor for issuers, companies, repurchasing their own common stock in the open market, protecting them from charges of market manipulation, provided they meet specific conditions regarding timing, volume, price, and the use of a single broker-dealer. The rule does not apply to tender offers, secondary offerings, or other types of corporate transactions. Its purpose is to allow companies to manage their share count and capital structure without inadvertently running afoul of anti-manipulation rules. Question 22. A market participant places a series of small rapid buy orders at successively higher prices to artificially drive up a stock's price, immediately followed by the sale of a large block of stock held by the participant. This is a classic example of painting the tape. B. Wash trading. C. Capping. D. Marking the close. Answer: A. Painting the tape. Explanation: Painting the tape is a manipulative practice where traders create a flurry of apparent buying or selling activity to give a false impression of trading interest and price movement. By executing a series of small trades at increasing prices, the perpetrator hopes to induce other investors to join the buying frenzy, allowing them to offload a larger position at an inflated price. This tactic is designed to mislead the market and manipulate the stock's perceived value and momentum. Question 23. Which type of order allows an investor to specify a maximum price they are willing to pay, and requires any executable portion to be filled immediately, with any unfilled balance cancelled? Limit order. B. Market order. C. Fill or kill FOK, limit order. D. Immediate or cancel IOC, limit order. Answer: D. Immediate or cancel IOC, limit order. Explanation: an immediate or cancel IOC, limit order combines the price protection of a limit order with the condition that any portion of the order that can be filled immediately at the specified limit price or better must be filled, and any remaining unfilled portion must be cancelled. This differs from a fill or kill FOK order, which requires the entire quantity to be filled immediately or cancelled. Question 24. A broker-dealer receives an all or none AON limit order to sell 500 shares of XYZ at $20. The current market shows 300 shares available at $20 and 200 shares available at $19.95. What will happen to the order? A. The order will be partially filled for 300 shares at $20. B. The entire order will be filled for 500 shares, with 300 at $20 and 200 at $19.95. C. The entire order will be held in the book until all 500 shares can be executed at $20. D. The order will be cancelled immediately due to insufficient shares at the limit price. Answer: C. The entire order will be held in the book until all 500 shares can be executed at $20. Explanation: an all or none AON order specifies that the order must be executed in its entirety or not at all. Unlike a fill or kill FOK order, an AON order does not require immediate execution. Therefore, if the full quantity is not immediately available at the specified limit price, the AON order will be held in the order book until the entire quantity can be executed at the limit price or better. It will not be partially filled, nor will it be cancelled immediately unless it also carries an immediate or cancel IOC instruction. Question 25. What is the primary risk addressed by the circuit breaker rules in the U.S. equities market? A. Individual firm insolvency. B. Market manipulation by large traders. C. Extreme market volatility and systemic instability. D. Broker-dealer failure to execute customer orders. Answer: C. Extreme market volatility and systemic instability. Explanation: circuit breakers, also known as trading halts, are rules designed to mitigate extreme market volatility and prevent systemic instability. They are triggered when major stock market indexes, like the S&P 500, decline by a certain percentage, e.g., 7%, 13%, 20%, within a trading day. These halts provide a temporary pause in trading, allowing investors to process information, reassess their positions, and restore order to the market. They are a crucial mechanism for managing crises and maintaining market confidence. Question 26. An order marked IOC, immediate or cancel, for 1,000 shares at a limit price of $25 is submitted. If 700 shares are immediately available at $25, and no more shares are available at that price, what will happen? A. The entire order will be cancelled. B. The 700 available shares will be filled, and the remaining 300 will be cancelled. C. The order will remain open until 1,000 shares can be filled. D. The 700 shares will be filled, and the remaining 300 will be filled at the next available price. Answer: B. The 700 available shares will be filled, and the remaining 300 will be cancelled. Explanation: an immediate or cancel IOC order requires that any portion of the order that can be filled immediately at the specified limit price or better must be filled, and any remaining unfilled portion must be cancelled. In this case, 700 shares are immediately executable at $25. Therefore, those 700 shares will be filled, and the unexecuted balance of 300 shares will be cancelled. This instruction ensures that the trader receives what's available quickly without leaving a residual order open in the market. Question 27. Under FINRA Rule 2269, what is required when a broker-dealer acts as a principal in a transaction with a customer? A. The broker-dealer must disclose that they are acting as a principal and obtain the customer's prior written consent. B. The broker-dealer must disclose their capacity, principal, on the confirmation statement. C. The broker-dealer must always charge a commission for the transaction. D. The broker-dealer must guarantee the customer a specific profit on the trade. Answer B. The broker-dealer must disclose their capacity, principal, on the confirmation statement. Explanation: FINRA Rule 2269 concerning disclosure of capacity requires a broker-dealer to disclose whether it acted as a principal or an agent in a transaction with a customer. This disclosure must be made on or before the completion of the transaction, typically appearing on the customer's confirmation statement. While prior consent may be required in some specific situations, e.g., discretionary accounts or specific types of securities like penny stocks, general principal transactions only require confirmation disclosure. This transparency ensures customers understand how their broker-dealer participated in the trade and how they were compensated. Question 28. When is a broker-dealer required to obtain a locate for a security under Regulation SHO before a short sale order can be executed? A. Only for short sales of penny stocks. B. Only for short sales of threshold securities. C. For all short sales in equity securities. D. Only if the customer requests a hard-to-borrow security. Answer: C. For all short sales in equity securities. Explanation: Regulation SHO's locate requirement, specifically Rule 203b. 1. Mandates that a broker-dealer must have reasonable grounds to believe that the security can be borrowed and delivered on settlement before executing any short sale order in an equity security, regardless of whether it's a penny stock or a threshold security. This is a fundamental requirement to prevent naked short selling and ensure orderly settlement of transactions. The locate must occur before the short sale execution, not just for hard-to-borrow or threshold securities. Question 29. What is the primary purpose of an exchange specialist, now DMM designated market maker, on an exchange? A. To provide research and investment advice to retail clients. B. To ensure a fair and orderly market in their assigned securities by providing liquidity. C. To underwrite new issues of securities for corporate clients. D. To process customer complaints and resolve disputes. Answer B. To ensure a fair and orderly market in their assigned securities by providing liquidity. Explanation: The primary purpose of a designated market maker, DMM, formerly known as a specialist on an exchange like the NYSE, is to maintain a fair and orderly market for the securities they are assigned. DMMs achieve this by providing liquidity, buying when there are no buyers, selling when there are no sellers, managing the order book and facilitating price discovery. They have affirmative obligations to both buy and sell, acting as both broker and dealer to ensure smooth trading, especially during volatile periods. Question 30. A broker-dealer receives two customer orders at the same time, a buy limit at $50 and a market buy order. The current best offer is $50.05. What will be the most immediate outcome for these orders, assuming no other factors? A. The market buy order will be executed, and the limit buy order will be placed on the order book. B. Both orders will be placed on the order book, awaiting price movement. C. The limit buy order will be executed first because it has a specified price. D. The firm will contact the customer for clarification on the limit order. Answer: A. The market buy order will be executed, and the limit buy order will be placed on the order book. Explanation: A market buy order demands immediate execution at the best available price, $50.05 in this case. A buy limit order at $50, however, will only execute at $50 or better, lower. Since the current best offer is $50.05, the limit order is not immediately executable and will be placed on the order book, awaiting a price drop. Therefore, the market buy order will be executed while the limit order awaits its price condition. Question 31. A municipal finance professional, MFP, for a broker-dealer makes a political contribution to an official of an issuer with whom the broker-dealer is seeking to do municipal bond business. What is the key regulatory concern under MSRB Rule G37? A. The contribution violates anti-fraud provisions if it's not disclosed. B. The contribution, if exceeding a de minimis amount, may trigger a ban on the broker-dealer engaging in negotiated municipal business with that issuer for 2 years. C. The contribution is always prohibited regardless of amount. D. The contribution must be publicly disclosed within 24 hours of being made. Answer: B. The contribution, if exceeding a de minimis amount, may trigger a ban on the broker-dealer engaging in negotiated municipal business with that issuer for 2 years. Explanation: MSRB Rule G37 is designed to prevent pay-to-play practices in the municipal securities market. It states that if an MFP makes a contribution to an official of an issuer that exceeds $250 per election, the broker-dealer is prohibited from engaging in any negotiated municipal securities business with that issuer for 2 years. This de minimis exception of $250 applies only if the MFP is entitled to vote for the official. The rule aims to ensure that municipal business is awarded based on merit, not political contributions. Question 32. A broker-dealer executing an order for an institutional customer receives payment in the form of delivery versus payment, DVP. How does this impact the settlement process? A. The customer must pre-fund the account with cash before the trade can be executed. B. The broker-dealer can deliver the securities to a third-party agent only upon simultaneous receipt of payment from that agent. C. The broker-dealer is required to extend margin credit to the customer for the transaction. D. The customer delivers the securities to the broker-dealer, and payment is made directly to the customer. Answer: B. The broker-dealer can deliver the securities to a third-party agent only upon simultaneous receipt of payment from that agent. Explanation: Delivery versus payment, DVP, also known as receive versus payment, RVP, for the other side, is a common settlement procedure for institutional clients. In a DVP arrangement, the customer's cash payment is made to the broker-dealer simultaneously with the delivery of the securities to a third-party custodian bank designated by the customer. This process minimizes credit risk for both parties, as the broker-dealer delivers securities only upon receipt of payment, and the customer makes payment only upon receipt of securities. Question 33. Which of the following would constitute a manipulative activity under securities laws? A. Placing a limit order far from the current market price. B. Selling short shares of a company based on a negative research report. C. Engaging in a series of wash sales to create the appearance of active trading. D. Participating in an auction for municipal bonds. Answer: C. Engaging in a series of wash sales to create the appearance of active trading. Explanation: A wash sale is a manipulative trading activity where an investor simultaneously buys and sells the same security, or substantially identical securities, creating the appearance of active trading without any actual change in beneficial ownership or risk. The primary purpose of such transactions is often to create artificial volume or prices, mislead other market participants, or generate commissions, rather than for legitimate investment reasons. This practice is strictly prohibited by securities laws as market manipulation. Question 34. When a broker-dealer acts as an introducing broker, in a fully disclosed account arrangement, what is its primary responsibility? A. To execute all trades and maintain custody of customer funds and securities. B. To process transactions and provide trade confirmations to customers. C. To accept customer orders and introduce them to a clearing firm, which handles all other back-office functions. D. To conduct proprietary trading for the firm's own account. Answer: C. To accept customer orders and introduce them to a clearing firm, which handles all other back-office functions. Explanation: In a fully disclosed account arrangement, the introducing broker accepts customer orders and introduces them to a clearing firm. The clearing firm then handles all other back-office functions, including executing trades, maintaining custody of customer funds and securities, and providing trade confirmations and account statements. The introducing broker's primary role is client acquisition and relationship management, while the clearing firm handles the operational and regulatory heavy lifting, and the identities of customers are known to the clearing firm. Question 35. Which of the following disclosures is typically required in a research report under FINRA rules if the member firm, or its affiliate, has a significant financial interest in the subject company? A. The firm must wait at least 72 hours after publishing the report before trading the security for its own account. B. The firm must disclose whether it or its affiliates own beneficially 1% or more of any class of equity securities of the subject company. C. The firm must prominently disclose that it maintains an order for the purchase or sale of the security if applicable. D. The firm must obtain prior approval from FINRA for the content of the research report. Answer: B. The firm must disclose whether it or its affiliates own beneficially 1% or more of any class of equity securities of the subject company. Explanation: FINRA Rule 2241 Research Analysts and Research Reports mandates specific disclosures of potential conflicts of interest. Among these, Rule 2241b(1)(b) requires disclosure of whether the member or its affiliates own beneficially 1% or more of any class of equity securities of the subject company. While other disclosures related to firm trading activity or orders may be required by internal policies or broader anti-manipulation rules, this specific percentage ownership disclosure is a direct requirement of FINRA Rule 2241 regarding significant financial interest.